Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. We'll be taking a look today after the big sell-off and big spike in VIX implied volatility at some iron condor comparatives. In particular, going to use Amazon. It kind of works across the board, but certainly Amazon one that has been taken out to the woodshed along with the rest of the market. So let's jump in and take a look. First of all, here is the chart on Amazon as of Friday's close. You can see Amazon certainly getting oversold on a technical basis. We're seeing Bollinger percent B dip into negative territory, MACD deeply negative, RSI at about the lowest levels we have seen over the past year. More importantly, IV at the highest level since COVID. Stock trading at a huge discount to the 20-day moving average. Last time we really set up this well was back on the lows, and the last time the stock was trading near this level back in kind of early August. So kind of did a comparative going back to that time frame. Here is pulling off from August 14th when the stock was pretty much at the same price, closed at 170.10. Friday closed at 171. Pulled off the basically 37-day iron condor trade back then. So going out to selling the 155 150 put spread, the 190 195 call spread, both of them well out of the money, have over 15% downside, almost 20% upside cushion, in this market environment. Getting a cushion to, in essence, be wrong, I think, is important. Plus, it's defying risk trade, the most you can risk is 5 points, Either one side or the other is going to get in trouble. That is very important as well. You can see the IV back there just under 30, and the spread, the iron condor trading a little bit under a buck at about 86, 87 cents or so. Fast forward to Friday's close, we see the stock price virtually at the same price, 171 versus 170 and change earlier. Days to expiration, very similar as well, But that iron condor trade now trading at $3.20, so over $3. Previously, back in August, it was trading under a buck. Why? Because of this huge jump in implied volatility, shooting up to almost 60, just under 60 at over 56, basically doubling on an IV front. You can see the same sort of cushion again. We're looking at 16 points to the downside, 19 to the upside. So basically Amazon in the next 40 days or so, a little over a month, as long as it remains well behaved, basically has about 8% and about 11% cushion to either way. You should capture that very nice 320 premium. How does that set up from then till now? So I pulled it off on a side-by-side comparison. Back then, the stock was at 170.23, now at 171, so virtually the same price, especially for an iron condor where you're selling both sides, Days to expiration, virtually the same. And certainly today you're going to have 2 more days peel off, so it will be the same as we get into the next trading day on Monday. But the iron condor price, jumping from under 90 cents to well over $3, so a huge jump in the net credit you can receive, which then lowers your risk on the trade, You still have 9% or so downside cushion, over 11% upside cushion, very similar to before as well. But the IV, as we said, over 55, before under 30. So before you saw the max loss on the trade, which is simply the 5-point wide spread with less the credit received, You had $413.50 of risk to make $86.50. Most you can make is what you sell it for. So your return on risk was a very respectable 20-ish%, with a little over a month to go with a nice cushion up and down. Fast forward to Friday's close, Your maximum loss now, because you're getting $3.20, reduces your max loss to $180. Before it was over $400, now less than $200. Your max gain has exploded from under $100 to over $300, meaning your return on risk, what you can make for what you risk, has just absolutely gone through the roof at over 175%. All because this huge jump in implied volatility. Also interesting to note that the deltas all, when you get this jump in implied volatility, right, gravitate towards 50. So we can see here the delta on the 190 call now at 29, the delta on the put at negative 30 with the stock at 171. If we go back to the previous time, we can see the delta on that put was 16, right? Stock virtually at the same price. The delta on the call, right, was 13. So you saw, because of this jump in IV, interesting thing to note, all deltas move towards the absolute value of 50. Obviously, put deltas have a negative, call deltas a positive. So this is a way to take advantage of this huge jump in implied volatility to position for maybe the selling to slow down, and obviously stocks not to rip back towards their previous highs anytime soon. So over the next 40 days or so, just looking for it to stay within about a 10% range, which is a very nice range, but getting hugely paid now, 320 net credit versus less than $1 prior. So hopefully provide some insight into how we go about looking to identify opportunities here to take advantage of. Take care.